Hello students, I welcome you all to this video lecture on customs duty. In this particular video lecture, we'll try to learn in brief the theoretical aspect of this particular chapter. So, first of all, what is customs duty? Customs duty refers to the tax imposed on the goods when they are transported across the international borders. The important keywords here are international borders. The objective behind levying customs duty is to safeguard each nation's economy, jobs, environment, residents, etc. by regulating the movement of goods, especially prohibited and restrictive goods in and out of any country. So by now you would have understood customs duty is not levied on movement of goods within the country. It is levied on movement of goods in and out of the country. So the objective behind this is to safeguard the nation's economy and also provide enough employment opportunities to the citizens of each country, right? So let's move on. Every good has a predefined rate of duty that is determined based on the various factors, including where such goods was acquired, where such goods were made, and what these goods are made of. For example, let us say if a product is manufactured in China and if a product is manufactured in USA, or let us say a product is manufactured in France, a product is manufactured in UK and it is imported into India. In that case, in each of these cases, that is product manufactured in country A, country B, country C, country D, the rate of customs duty or other duties under the umbrella of customs duty will be different. So here what gains importance is where was such goods acquired, where were those made, and most importantly what are these goods made of. For example, if a product that you are importing is a necessity, it will relatively have a lesser duty, whereas if a product which has been imported is a luxury goods, then there will be higher duties, right? Also, anything that you bring into India for the first time should be declared as per the custom rules. So any product that has not been mentioned in the list, if you are bringing a new product, then in that case you have to declare that you have brought such goods into India for the first time. For instance, you need to declare the items purchased in a foreign country and any gifts which you acquire outside India. Whatever you are bringing to the country while entering India, you'll have to declare everything that is there with you, right? So next, types of customs duty. Under the umbrella of customs duty, there are various duties that are applicable. For this particular video, I have restricted myself to explain only those concepts which are there for our syllabus. Keeping the syllabus in mind, I have taken certain duties that are very important for you to understand. So I have taken them in order of the format itself. The format is explained in the next video. So once you understand this and look at the format, it will be very easy for you to proceed further. So first there will be basic customs duty, then there is something called as national calamity contingent duty. I'll explain every duty in detail. Countervailing duty is there. Social welfare surcharge, give importance to this word, surcharge. Safeguard duty, protective duty, anti-dumping duty, IGST, integrated goods and services tax, compensation cess on custom duty. So these are the important duties that we have to acquaint ourselves with in order to solve the illustrations that are there in our syllabus. So the first one, basic customs duty. This is the tax that is calculated on the assessment value of the goods that have landed at the customs border of India. So there will be something called as assessable value. It will be either given in the illustration or we'll have to find it out. We already know how to find out assessable value of goods which have been imported from other country or which have been manufactured. So once we find out the assessable value, we'll have to apply basic customs duty on that particular goods based on this assessable value. It can vary from 0% to 100%. Basic customs duty depends upon the HSN code of the product and the country of import. HSN code is nothing but a specified code given to each of the commodity that are being manufactured all over the world, so that it will be easy to recognize a product as same product in various countries, because the same product can be called in various other terms in various countries. So to bring uniformity, the international agencies have come up with this idea of HSN code, which is one particular code for a particular commodity, right? So the country of import is also important while applying basic customs duty. The next one is national calamity and contingency duty. The NCCD is tax imposed on pan masala, cigarettes, cellular phones and other tobacco products. It was introduced under Finance Act of 2001. So it is, NCCD is generally applicable on specified products, and if you see here, except for cellular phones, it is usually levied on the SIN products, right? So the next one, countervailing duty. Countervailing duty is a specific form of duty that the government imposes in order to protect domestic producers by countering the negative impact of import subsidies. CVD is thus an import tax by the importing country on the imported products. You need not get confused here. Only thing you have to understand is it is to protect the domestic producers. Some people use subsidies as a way to reduce their value of import. So what do? Is government takes charge to make sure that the domestic producers' interests are not harmed by this. So countervailing duty is applied in order to protect their interests. The next one, social welfare surcharge. If you can recollect, all the other duties that we discussed had duty at the end, but here it is social welfare surcharge. And whenever we know this already, whenever there is something called a surcharge, it is always taxed on the duty, total duty up to that, right? So while solving the illustration and also while looking at the format, you'll understand this in detail. It is a tax imposed on the value of goods, including the BCD value, basic customs duty, whatever is there. On that we will basic customs duty plus NCCD plus CVD. There will be 3 duties. In most of the cases there will be only basic customs duty. In certain cases there will be NCCD also, there will be CVD also. We will add all the 3 duties, and on that total of duties we will impose social welfare surcharge. It is generally charged at 10% unless the goods is exempted from this tax. Safeguard duty is tariff barrier imposed by government on the commodities to ensure that imports in excessive quantities do not harm the domestic industry. It is mainly temporary measure undertaken by government in defense of the domestic industry, which is harmed or has potential threat of getting harmed due to sudden fall in prices of imported goods. Let's say the imported goods, because of various reasons, there are various reasons, for example devaluation of currency or any other reason, suddenly a good becomes damn cheap when compared to the domestic producer's product. So in order to safeguard the domestic industry and interests of domestic industry, the government kicks in and brings a safeguard duty to make sure that the domestic industry has to go through a difficult phase. And most important here is this is only a temporary measure. Protective duty, this is levied for the purpose of protecting indigenous businesses and domestic products against overseas imports. The rate is decided by tariff commissioner. An anti-dumping duty is a protectionist tariff that a domestic government imposes on foreign imports that it believes are priced below fair market value. We all know there is a dumping of products going on across the world. So in order to make sure that that does not happen and it does not harm the domestic industries, what does the government do is they come up with this anti-dumping duty. They take note of the price of the products that are imported, and if they feel the price are way below fair market value, that is in the country, the domestic industry will not be able to cope up or face competition against these prices. At that point of time, government kicks in and brings up anti-dumping duty. Dumping is a process where company exports a product at price lower than the price it normally charges in its own home market. This is because they want to capture the market share. Now it has become fashion to sell below cost price, to sell without any profit, so that once they get market share, then they'll expand their business and then they'll raise the prices. So to make sure that does not happen, and most importantly, quality will also be a factor here. So to make sure that that does not happen in country, central government kicks in with the anti-dumping duty. For protection, many countries impose stiff duties on products they believe are being dumped in their national market, undercutting local businesses and markets. I have already explained this. As GST is consumption based tax, the state in which the consumption of goods and supply happen would be eligible for indirect tax revenue. We have discussed this at the beginning of this particular course, that earlier the tax used to be collected in the manufacturing states, and manufacturing states used to get higher pie or bigger pie of the tax revenues. But after GST was introduced, they came up with destination based tax, that is wherever the state where the goods are manufactured does not matter, where the goods are consumed matters a lot. So because of this, some states where there is no manufacturing activity going on, they'll get higher revenues compared to pre-GST regime, and states which were heavily dependent on manufacturing, those will lose out on revenue. So to compensate for them, they have the government has come up with compensation cess. Hence, after GST coming into effect, some states that are net exporter of goods or services are expected to experience a decrease in indirect tax revenue. To compensate for them, to compensate the states for the loss in tax revenues, GST compensation cess has been declared by the central government as per Goods and Service Tax 2017. GST compensation cess would be levied for a period of 5 years from GST implementation. So the compensation will be provided to the states also only for first 5 years. Thank you.